Let's discuss that with Krishna Sangvi. He's the CIO Equity at Mahindra Manulife MF. Thanks so much, Krishna, for making time and speaking with us. To begin with, what's your understanding of the market? What's a realistic return expectation that people should have for the next 12 to 18 months, and what's the best place to put the money right now?
I think market typically follows, economy and earnings. So in a way, the only challenge is markets are not linear. So to an extent, sometimes they run up slightly ahead of the earnings and economy. And only way to look at that is by looking at past returns. So if you look at last 12, 18 months period, we possibly can sense that a lot of returns were upfronted in last 18 months period, which perhaps means that the way markets are poised right now, while economy might do its own normal catch up over time, because economy is going to be far more linear than the market behavior. So we should actually prepare ourselves for a time frame which says that okay, markets may be a little bit more into consolidation phase over next 12 months, maybe where incremental returns will be generated far more by stock specific actions rather than aggregate market behaving in a particular direction.
Right. So how long can this time frame of consolidation continue for the markets firstly? And during this consolidation phase, which are those sectors that investors should focus to accumulate right now?
Yeah, sure. I think honestly, it's very difficult to guess, this consolidation time frame, because let's face it, in the sense that the primary challenge in the markets is a reason right now is because there has been a sharp bout of selling by global investors in last maybe 4, 6, or 8 weeks period, right? So, but for this selling, clearly, even if market had affronted some returns, we were reasonably okay. So, to an extent, one has to be aware of the global parameters, maybe the liquidity or the selling pressure from FPIs, which might create this challenge of judging whether it's 12 months or 6 months or maybe 18 months. Difficult to guess, but let's look at it from earnings side, which says that okay, earnings this year has been reasonably weak in the first half. Hopefully, we do the catch up in line with the expectation, saying that because first half had little bit impact of election, where first 2 months possibly had some sort of a slowed expenditure side. So as the expense builds up from government side, etc., we do catch up on economy this year, and earnings do follow. So that's one way to look at it. Other side, within this market, even when earnings are more or less in this 5% range, you'll always find companies which are sectors growing in that double digit, as well as companies might having challenge on earning growth. So if you look from earning perspective, clearly financials has emerged as a sector even in last quarterly season, which did pretty well. Broadly, financials looks interesting. Maybe some companies, maybe something in IT can be interesting, because the expectations of recovery or earning growth in US can come post the change in presidency there, where maybe tax rate cut is a big expectations. Otherwise, core India stories of manufacturing does play out. The only challenge really is how to integrate valuations in some of these companies. As as did mention, returns were partly upfronted in last 12, 18 months.
Okay, yes, that's the problem everyone is facing, that the returns have been front-ended. So how do you marry the valuations with growth? You talk about a couple of sectors, IT, financials, how they are looking, well poised. But what's the way forward when it comes to real estate? Because that cycle too has been panning out quite okay for the last couple of years. Now, given the fact that all the cycles in this market are getting very, very narrow and shortened, do you expect that this cycle is also expected to be short-lived, or do you expect that return of that 7-8 year bull cycle for the real estate market?
Actually, real estate as a space has done quite well even in last 3 years, right? So we can't really, complain about the returns made in last 3 years on both equity markets and partly on the underlying real estate itself. So my sense really is that real estate cycle is finally an outcome of economy, and our core thesis is simple, that as economy grows, per capita income grows, people prosper, and when they prosper, they look for a change in their own, let's say, residential things, as well as the economy grows, corporates come up with their own requirements for industrial and office areas. I think those things are pretty much in place. So I'll say real estate cycle is good from a demand side. Maybe the price point does vary, so select pockets of whether it's more of affordable versus more of premium or super premium. That is slightly more city specific issues which one can get it. One need not worry too much. But yeah, broad real estate cycle is good as long economy stays on track.
Right. Okay. You did say that you prefer the financial space, but financial space itself is a big counter. In that, how does your preference lies? Do you prefer private banks more, PSU banks, or NBFCs? And what are your thoughts when it comes to ancillaries like the capital market ancillaries that we have currently listed?
Yes, I think instead of focusing on private versus public, we'll try to focus where the predictability of the margin profile going ahead is better, where the credit cost concerns are less. So that will focus on those areas of identifying companies in the lending space, so whether it's banks or NBFC, and clearly capital market is the overall space, which is what we are discussing about overall wealth creation. So they are in a way eventual beneficiaries of the capital market boom. The only challenge in capital marketplace really is a little bit circularity comes in, because markets are good, earnings are also good, and markets, if at all they falter, earnings possibly impact. So that's a little bit tricky to adjust on valuations, but yeah, clearly that's also a preferred space.
Okay, so that's a point coming in within financials, how you should look at the entire segment. But lastly, before I let you go, wanted to get a better sense on PSUs as a basket, because power financiers, defense, railways, a lot of these segments had done very well, even oil and gas for that matter, and there was a reason for that. Do you think it's now priced in, or do you think this is just a lull and they'll resume the uptrend?
Yeah, similar. So maybe some of the returns could have been upfronted, but as long as one gets a comfort that the basic earning profile for some of these companies is intact, and for many of these PSUs, especially which are in the core economy sectors, the gestation period of a new project and the outcome of those profitability, etc., takes slightly more time. So if you integrate that pace, and maybe the capex is being incurred by those companies right now, and the outcome is going to be 2 and 3 years down the line when those plants gets operational. So I'll possibly say similar. While those companies have done well, maybe a little bit of a consolidation, etc., while the earnings do catch up in next couple of years.
Okay, point taken. On that note, we'll let you go. Thanks so much for making time and speaking with us today. Really appreciate your time.
If you like this video, then like, share and subscribe to ET Now.